In this video, I'm going to show you how to calculate the operating cash flow ratio. So it's pretty simple. You take a company's cash flow from operating activities, which is also called operating cash flow. That'll be on their statement of cash flows, and you divide it by the current liabilities, which you'd find on the company's balance sheet. Now, what does this ratio tell you? This is telling you how good a position the company is in to be able to pay its short-term debt. Now, normally we'd look at something called the current ratio, where we take a look at the current assets and divide it by current liabilities. And remember, current assets includes things like cash, accounts receivable, and so forth. However, even though the company might have cash to pay their liabilities in the short term, we want to see in the long run, is the company generating enough cash flow from its main operations to be able to pay its bills? And if it's not, it's going to eventually have to borrow money or potentially sell fixed assets and so forth. So let me calculate this ratio for you for an actual company. Let's take a look at Twitter. And so we've got Twitter's financial statements here. And so we see in their statement of cash flows, you'll see that they have net cash from operating activities of $1.339711 billion. Okay, so a little over $1.3 billion. And now, so that's going to be the numerator in our equation, but we need current liabilities from Twitter's balance sheet. So we come and we've got liabilities right here, and we've got various current liabilities, and then the total current liabilities. Okay, so that's $1.516311 billion. Okay, so now we can go and we can calculate our ratio for Twitter. So we've got a little over 1.3 billion of cash flow from operating activities divided by a little over 1.5 billion of current liabilities, and that's going to come out to 0.88. Okay, so that would be their operating cash flow ratio for Twitter for 2018. Now, what does this mean? How do we interpret this? Well, it's below 1. So that means that if Twitter were completely dependent on its cash flow from operating activities, it wouldn't be able to have enough money to satisfy its current liabilities this period. However, remember that Twitter has cash and so forth right now, that they have some other current assets where they can satisfy their current liabilities. But in the long run, they want to be able to increase their cash flow from operating activities even further.